This podcast is intended for investment professionals only. All investing involves risk.
Hello and welcome to this special podcast ahead of the publication of our 2025 Global Outlook, which offers our key views across public and private markets in what promises to be yet another dramatic year for investors. I'm Max Julius, Head of Content, and I'm delighted to be joined by what I believe is a record number of speakers on one of these calls. On our panel is Sonja Laud, our Global CIO, Jeffery, Head of Macro Strategy, Colin, Reedie, Head of Active Strategies, Rob Martin, Global Head of Investment Strategy and Research Private Markets, and Howie, Global Head of Index and ETFs. Good morning, everyone.
Good morning.
Good morning.
Well, Sonja, with no further ado, how would you characterize the year we've just had, and what themes do you expect to shape the investment landscape in 2025?
Thank you, Max. So let's start with an easy question, hey? So I thought we have so many experts in the room that will go into the detail across the asset classes, across public and private, that I will share a few really interesting stats that hopefully provide food for thought. But I think it's been very much characteristic of 2024. And the title I chose is The Year of US Exceptionalism Again. And the stats I would like to share is, and they're quite staggering. So global investors are committing now more capital to a single country than ever before in modern history. The US is now 70% of the leading global stock index. Relative prices in the US are the highest since data began over a century ago. The equity risk premium in US equities is close to zero, actually has been negative for a short while. Credit spreads remain at or near cycle lows. Exceptional diversion in growth profile, of course, of the US versus the rest of the world is very often cited as a key reason. Alongside this, of course, it's the earnings growth that has driven most of the exceptional equity market returns. But again, you now have various ways to slice and dice the data, and it's been very clear that it's been the Max 7 and technology that is responsible for the vast majority of that diversion. We know that the US actually has earnings growth of 4% in real terms since the GFC, which is way ahead of its own long-run average of 1.75%, and of course has been way ahead of the rest of the world. But it's interesting that the rest of the world actually had its major earnings bubble, so to speak, ahead of the GFC and have since been normalizing. So you had a slight reverse between the US and the rest of the world. Just a final stat, actually consumers in the US are expecting higher share prices, and that view is at an all-time high as well. Now, of course, one of the major events in 2024 has been the US election and the re-election of President Trump. Now, if you look at everything I've just said, it's very clear that so far markets are pricing all the good stuff without any of the potential negative implications of the potential policies that the Trump presidency might bring. Other interesting stats is actually when you compare that expectation and you look at the market features of 2016 versus 2024, they're quite stark. The S&P was trading at 19 times, 10-year yields were below 2%, corporate tax rate were at 35%, and the nation's debt to GDP was at 75%. You fast forward to 2024 and we have the S&P at 22 times, 10-year yields around 4.5%, corporate tax rate already at 21%, and the nation's debt to GDP at 125%. So that is so important in understanding whether the classic trades around the Trump administration actually can sustain in 2025. Now, Warren Buffett is one that people are listening to, and he has surprised market commentators that he is holding now $355 billion in cash. His rationale, the US stock market is valued at 2 times GDP. Now, adding the debt market into that analysis, the numbers become even more stark. The US economy is approximately 35 trillion in size. The listed equity market is valued at around 70 trillion. The listed bond and credit market is valued at 70 trillion. And that means that overall, the market is valued at about 4 times GDP if you look at all liquid capital market instruments. The rest of the world looks as follows: combined GDP of approximately $65 trillion and is valued at 35 trillion in equity and 35 trillion in liquid bonds and credit, which means it's roughly 1 times GDP. And this is even before you add private markets to the equation, where in fact the US accounts for 70% of all global investments in private markets across both equity and credit. So there's a lot of food for thought in trying to figure out what 2025 might bring. But I thought that this is really relevant in understanding whether the sentiment around the US exceptionalism is now fully priced and what we can assume the rest of the world might look like in that context, and whether indeed the expectation that equity markets can only go up is well-founded by fundamentals.
Well, thank you very much, Sonja, for that long-term perspective and really stunning numbers there. You've posed a serious question for Chris, who I'm going to turn to next, about whether these trends can persist. So, Chris, what are your key asset allocation views in light of the macro backdrop Sonja has just outlined?
Yes, Sonja's put a lot of interesting numbers on the table there. But one word, I was listening very carefully, one word she didn't use was the B word. I never heard the word bubble being uttered from Sonja's lips. Despite the kind of heady valuations on a number of metrics, Sonja mentioned 22 times earnings on the S&P. I think on a few other cuts of earnings, you can get even higher numbers than that, up to 25 times. We struggle to think of this as being a classic bubble because it has been so rooted in the fundamentals of strong earnings growth. Now, that earnings growth has been very concentrated, as Sonja illustrates, and it has led to very differential performance between US and European assets. But we're not yet leaning against that. I want to kind of give a rationale for that. If we kind of are pricing a cash flow into perpetuity, then the difference in the discount rate you need to apply to get to a 25 times earnings multiple versus a 15 times earnings multiple, so roughly the difference in US and European equities, is only 3%. So can I believe in a world where there's a 3 percentage point difference, maybe not in perpetuity, but for a long time, between the earnings delivery of US companies and European companies? And I'd have to say I can believe in that world, or at least I can put a decent probability on it, given the record of delivery or lack of delivery in Europe's case. So we're not also kind of willing to use the B word to describe what's been going on in the US equity market. We continue to prefer to take our risk on the asset allocation team in equities than in credit. I think there's a much clearer mapping between whatever your snapshot of valuations is today and forward returns in credit than in equities. And we can kind of talk about the earnings multiples, but you also mentioned the tight credit spreads. I think the tight credit spreads are a much more useful kind of indicator of returns over a 1 year or 2 year period. So a clear kind of equity over credit preference. You didn't mention the FX market, so I'll kind of go there next. If there is sort of one widespread kind of almost overwhelming consensus of what the new US administration means in financial markets, it's a stronger dollar, and that's through a number of channels. It's through the tariff implications being strong for the US economy, but a weak read across into anybody on the sharp end of tariffs. We're a little bit skeptical about that theme, though, whether it can continue. So the way I think we think about this is the US is its current account deficit. So they buy more stuff from the rest of the world and the rest of the world buys from them. And if they choose to raise tariffs, then there's not a great deal that other people can do about it. We've seen comments from European and Canadian and Mexican leaders in the last few weeks, which suggests that they're willing to go to negotiation very quickly. But other countries can then turn around their capital account position, the mirror image of the US having this current account deficit with the rest of the world, as the rest of the world own lots of US assets. I mean, Sonja's spoken to the kind of numbers on the size of the US asset markets. Lots of that is owned by foreigners, because that's just the kind of corollary of having a persistent deficit on your current account. So I don't think there's enough focus in terms of what the countermeasures can be from foreigners owning lots of assets. I mean, let's just think about Chinese FX reserve holders as being a sort of stereotypical asset owner here that could choose to take measures which would be quite detrimental for the US if we end up in this escalating kind of trade and capital flow dispute. Just to kind of wrap it up, it's that prefer equities over credit. not yet willing to be leaning against the US equity outperformance within the credit market, within the equity market. Within credits, would highlight the kind of continuing kind of pockets of valuation that exist in high yield and emerging market debt, but can struggle a little bit with the case for investment grade at these kind of spread levels. And then pretty skeptical about whether this is going to be the dollar bull market that everyone seems to expect.
Okay, thanks, Chris. That's a really clear overview. Not too worried about bubble risk as well. The B word there. Colin, how is the team positioning across fixed income markets going into 2025? And how do you think the end of peak rates will impact investor preferences for cash? Of course, Sonja has just mentioned Warren Buffett's huge stash of cash.
All good questions. Thanks, Max. I think the starting point for us, and we've picked up on this already so far on the call, is that next year is going to be such a policy dominant year. And unfortunately for fixed income investors, it's less central bank policy and more politicians' policy, which has obviously got a lot more moving parts to it. We don't have an edge on what Trump will do, but right now everyone is getting to project their preferred version. The bulls see him as a deregulating tax cutter who will also control the deficit, and the bears as a spanner in the supply side because of tariffs, because of anti-immigration. You can distill this all down to one question for next year, which is, are you more worried about slowing growth or higher inflation? My sense is that chronologically, the bad may come before the potential good. Trump can hike tariffs and crack down on the border in day one executive orders, deregulation, tax cuts, fiscal changes will all require legislation, and that just takes more time. So I'm more worried about inflation than growth, although the reality is that if the supply side does shrink, both can actually disappoint, and that delivers a far nastier combination of weaker growth and higher inflation, and markets would likely struggle under that scenario. For fixed income markets under that scenario, long end rates could go even higher next year. We're pretty confident in the view that the rise in long end rates since the Fed started to ease has simply been due to the market lifting the floor on the Fed cycle. Next year, markets may have to price rate hikes, not necessarily in 25, but possibly for 26. So how you manage your duration exposure relative to your credit risk is going to be crucial again. And the challenge hasn't really changed. Chris has already touched on this. How do you account for credit spreads which are at or very close to multi-decade tights, yet the asset class continues to see inflows because of the attractiveness of the all-in yield? Our regional investment grade teams remain relatively cautious. Interestingly, the global team, who's got the broader opportunity set, are a bit more constructive and biased towards euros away from the US in investment grade, given the very strong consensus view that US risk is bulletproof forevermore. We've obviously touched upon that. That constructiveness extends into our EMD and high yield teams, who are by their nature more total return focused, where that all-in yield is obviously a larger factor to be considered. But further support for EMD might come from the fact that if fiscal sustainability is a live issue, and we believe it is, in fixed income markets, then we need to differentiate between developed and emerging markets. It was the former that deployed fiscal policy so aggressively in response to the pandemic, and where, we've seen the fiscal incontinence continue since. If we get to a stage where bond markets, finally threaten enough is enough, then that's a developed market crisis based on current budget deficits. Just look at Europe now. It's the core of Europe. It's France. It's Germany. It's not the sovereign credit crisis post GFC, where it was Italy, Spain, and what have you. And that's a very different dynamic.
Thanks, Colin. I think it's better a somewhat gloomier view of the macro outlook than is priced in
Classic fixed income.
Classic bond investors' perspective. Rob, we've spoken a lot about public listed assets right now. What does all of this mean for asset classes within private markets?
Thanks, Max. I'm going to try and do a quick fire tour around a lot of different things. So if I start with private credit, certainly, and Colin's already picked this up, compared to the post-GFC period, the absolute yield, the all-in yield on credit is still relatively attractive versus the last 15 years. We're still seeing a lot of interest from asset owners into the asset class. Set against that, spreads are tight, and that also feeds into the private markets as well, because most investors are looking for a complexity premium versus publics, and so that's driven down spreads in the private markets as well. Now, at the moment, defaults have been incredibly low, surprisingly low, but I don't think we can afford to be complacent about that. So one of our key themes is about really robust credit assessment, particularly at this point in the cycle, looking forward 12 months into what is still potentially a really uncertain macro environment. We're also looking at the areas where you get paid relatively well for risk. So part of that is about origination. We put a lot of emphasis on bilateral conversations, so trying to get access to transactions which are not widely syndicated. That's a big part of what we do. But it's also about that complexity premium. One example is almost a new asset class, debt for nature swaps. It's a form of emerging market debt restructuring, but with very high credit quality. It's a really specialist area, but we think actually you get paid very well for the risk there. So that's one example. If I switch over to private equity, a lot of people are talking up the prospects for private equity in 2025, lower interest rates, deregulation in the US. We're actually quite a bit more cautious than that for the sector as a whole. Compared to other parts of the private markets, it's actually an area where valuations have been less aggressively marked to market. So we think actually the prospects for recovery in a general sense is frankly less. One of the areas that we're probably more constructive on is venture capital, which definitely has seen a lot of marking to market. Given, one of our sort of deepest footprints is in the UK, one area we think is very interesting is about financing spin-outs from universities, which takes technologies which is sort of driven by academia and then looks to scale it up and commercialize it. If I switch over to real estate, I mean, we're generally very much thinking about themes within asset classes, but if there is one asset class that has been marked down aggressively almost across the board, it is real estate. And so tactically, we do think it's an interesting moment for the asset class. That said, we still need to be selective. We've talked about themes. One of the areas that we and others are thinking about a lot is deglobalization. We think that's inflationary in a very broad sense. So one of the things we look for is pricing power. The kinds of sectors we're looking at when we think about that, housing and residential, but also industrial real estate. And there's also a more specific angle around it, industrial, in that deglobalization is definitely spurring more investment in supply chains, but also the reshoring that we were talking about for 10 years is actually now starting to happen, and we're seeing a lot more fixed investment. And that's particularly in the US, but we think it's going to happen in Europe as well. Conditions for retail and office are actually tougher across the board, but those are areas where actually they've been very heavily sold off, and actually we're starting to see some pricing which looks interesting. So we're buying selectively in those spaces. There's not that many people talking about that at the moment. And then in infrastructure, decarbonisation is still driving massive asset creation. It will continue to create a huge flow of opportunities. That's increasingly on the basis of cost rather than necessarily green objectives per se, which we think is very helpful. The other area that's seeing a huge amount of asset creation is digital infrastructure. So data centers, fiber, mobile connectivity. There's a lot of discussion around AI being the real driver there. It's part of the story, but actually there are other things going on. There's still a huge amount of consolidation from server rooms that used to sit in office buildings and in people's homes going into purpose-built data centers. Also, data sovereignty is an increasing factor, particularly in Europe. We think that's very bullish for demand. There's increasing bottlenecks on the supply side, and that actually is creating a really good demand-supply balance in that space, where we think actually there's some really interesting returns on offer. So that's a tour of the private markets.
Thanks, Rob. It's a great whistle stop for private markets with some big ideas in there as well. Howie, both Rob and Sonja have just touched on long-term themes. Which ones are you most excited about?
Do you know what? I think I'm going to talk about market concentration because it's really no longer an elephant in the room and many people are talking about it. And I expect this to dominate conversations in 2025. So you're asking me what I'm most excited about. It's recognizing those concentration risks, managing them, and in some cases, having discussions with clients around knowingly taking some concentrated views for the right reasons. So let me provide some color here across equities, bonds, and the commodities markets. So, if you going into next year, clearly the fear of missing out on returns will remain. And I anticipate that some investors will remain invested in buying things like global technology sector funds or AI ETFs to take these views. However, with that, there's an increasing appetite for more diversification in US portfolios specifically. So Sonja touched on this and the US markets. And if you look at something like the S&P 500, 31% of that standard index is in tech. That's more than twice the size of the next sector financials at 13%. So just by simply investing in 50% of the weight, you can do that in 30 stocks. Same with 117 stocks to get 75% of the weight. So we're fully expecting interest from clients to discuss creating custom benchmarks or portfolios to help them with actively designed indices to systematically manage or control these risks, not just on individual names, but also constraints on sectors, and for global benchmarks, perhaps geographies as well. But for market cap based investors in US equities, so that you want to stay traditional, then we suspect that sector investing is a potential solution. Adding exposures such as industrials or financials or utilities, or through high conviction themes like cybersecurity can balance some of these sector weights to desired levels. Now, another way to look at this is perhaps with a factor view, another way to manage otherwise unconsidered concentration risk in traditional market cap. And we know some investors are taking factor views on these markets or prioritizing high quality stocks in the weighting of the portfolio to provide essentially stability and manage concentration risks there. But we jump to fixed income. Now we know that global corporate bond benchmarks are heavy on the banking sector, given the large share of total issuance. And again, this can be managed through portfolios where you either exclude or reduce the banking sector to allow investors to gain exposure to corporate debt without sacrificing the potential benefits of diversification. Now, if we look at kind of government bonds and we've discussed the inclusion of India earlier this year into emerging market indices, and that already started with JP Morgan in their flagship index in June, and it will complete in March 2025. Same story with Bloomberg, start in January next month, and they will be for the next 10 months adding Indian government bonds into the emerging market index. But these indices will actually cap at 10%. And there will be some investors that want to take a view. And so again, concentration risk, they may look to add to it and potentially use ETFs to add Indian government bond exposures just because of the way that to access this, it's easy to set up, no local custody accounts, not having to deal with FX, potentially beneficial tax returns, and having a single price liquidity management. And then finally, we look at the commodities market. The benchmark that most people know, Bloomberg Commodity Index, 24 main commodities. And the traditional one will have weights which are fixed between commodity groups. And there are some out there which actually weight based on production weighted. And so you high focus on energy commodities. There are, of course, enhanced commodity industry strategies which track enhanced designs where you can actually change the weights between commodity groups, taking into account supply and demand and futures pricing. That's one way to manage it. But another way to look at it is actually perhaps through a longer term lens, through an allocation to commodities which are powering and enabling the energy transition. So that includes transition metals, transition energy, carbon pricing to capture the future demand growth in commodities driven by the global transition to net zero. So that's another way to consider managing concentration risks within the commodities markets. So concentration risk in itself is perhaps not what excites me, but really how we manage it.
Thanks, Howie, for that deep dive into concentration risk and a discussion of ways to become more diversified as an investor. Well, look, now we're going to do something slightly different for one of these calls, and we're going to have a quick fire round of questions with quick fire answers, where I'll ask each one of you for one non-consensus view about markets next year and the reasons behind it. And let's start with Sonja.
Thanks, Max. So now we've talked so much about the US. You have to wonder what is in store for the rest of the world. And we know that Europe in particular is valued at very reasonable levels. We know all the reasons for it. We know that tariffs will not help with the growth outlook. We have a very clear path for the ECB, and we have an election in Germany. Now, I'm German, so I'm allowed to talk about it. I think as the polls stand, we will see the re-election of the centre-right, the CDU, and I believe that this will change at least the perception. It will provide stability in Germany. And I know we're awaiting whether the French government will exist in 2025. The chances are not, but still a lot is priced already. And given everything we've said about the US, I probably would take that view.
Good, thank you, Sonja. Colin, over to you.
It's to do with sort of trying to plot potential geopolitical paths, which is obviously really hard to do with any sort of degree of accuracy. But Chris has already alluded to this, and one of the things that we think about longer term is the potential for the increased balkanization of the global financial system. So just as we're seeing technologies balkanize, social media networks in China are separate from those in the US. Could we see finance follow? Because there would be some pretty profound sort of potential knock-on consequences here. If the great pool of Chinese saving is forced to stay at home, it could contribute to the outlook for structurally higher real rates elsewhere. And another consequence of balkanization would be that multinational firms would have to deal with increasingly divergent set of regulators who could and would likely be more hostile under that scenario. So, an environment where finance becomes more weaponized is one potential tail risk here. Who would have their FX reserves, for example, or any other financial asset for that matter, held by a geopolitical rival?
Thanks, Colin. Howie.
I'm going to orientate myself around Chris's kind of narrative earlier and use the B word. And, I obviously touched on global technology and AI. And you know what? I do think, there's investors that will be interested in that. We just need to make sure we balance that against the risks that we discussed earlier. The other word that, Chris, you mentioned there was kind of the dollar bulls out there. And you know what? Mega cap earnings could be entering into a historical slower growth phase, and opportunities may therefore be sought in the US small cap market. And I'm sorry, Sonja, you did say we focused a lot on US, and I've just given an answer on the US market.
Okay, thanks, Howie. You mentioned Chris, so it's only right we go to Chris next.
Yeah, I'm going to flip across the Atlantic back to Europe and call out European autos in particular. So European auto equities trading on a PE of 6. In many cases, the book value of these entities is less than the cash that they have on their balance sheet. They are daily headlines about the struggles from the tariff risk and the struggles from Chinese competition, CEOs getting fired, etc. But they are finally grasping the nettle of cost reduction, and you're increasingly getting to the point where you just need to believe they're a going concern for them to be a good investment.
Okay.
Maybe they're not a going concern, but if they are, then
Okay.
there's upside.
Interesting. Thank you, Chris. Rob.
Thanks, Max. I think it's not so much a consensus view, but there is a sense that we might have hit peak interest in ESG or outcome investing, I think. And I really don't agree with that. And our own work has shown that for asset owners in general, but especially in their private market portfolios, there is still a huge emphasis and move towards increasing the ESG alignment and outcomes in investor portfolios. That's partly about sectors which are especially aligned, like clean energy, but I think it's more general than that. It's even about traditional real estate portfolios and working out how to tilt those in a more environmentally or socially impactful way. So I think that is something that people are sort of talking down, and I think they're wrong.
Okay, thank you. Really fascinating set of some quite spicy thoughts about next year. We'll have to gather again this time in December 2025 to see how those have panned out. Well, Sonja, we've covered a lot of ground just now. What are the key takeaways for investors?
Thanks, Max. And indeed, we have covered a lot of themes. And I think looking at everything that has been said, it's very clear that the level of uncertainty and the range of potential tail risks is very different to prior years. Why is that so important? Not only have we mentioned, and we've talked a lot about valuation levels, so understanding what risks you are compensated for in different asset classes as an investor is very important. What makes it even more difficult is something Colin mentioned, that the policy-driven market is turning political rather than central bank driven. And pricing political risk is something that developed markets are A, not used to, and B, hence not very well equipped. You speak to an emerging market investor and political risk is part and parcel of the valuation methodology, and in doubt they would be far quicker to consider what the considerations are, and I think in doubt they sell before they start wondering what on earth is going to happen. That is a fundamental shift. We are not used to this. And we've talked a lot about the eventual policies Trump will put forward. And we know, of course, that depending on the timing and the mix, the outcome will look different. Markets are not priced for this. For the time being, the market continues to believe in the Fed cutting cycle, and it does believe in the soft landing of the economy. The data does support it so far. And this is where hence the scenario analysis is coming in. Even if we were to assume this, the potential implementation of different policies will mean that this might well change throughout the course of 2025. And then this brings us straight back to valuations. Understanding where the asymmetry could come in will be incredibly important. The debate around the US versus the rest of the world will be equally important. Can we have another year of US exceptionalism with the rest of the world kind of muddling through? Despite the fact we've had a number of elections in those areas throughout 24, can we not assume that there will be policy decisions taken in those countries that will equally have an impact on their economic trajectory? Now, Europe stands out because we have Germany and France going potentially, I mean, Germany for sure, France potentially through new elections. And this can have a profound impact on Europe. And as I said before, the valuation levels are far more supportive because that risk is far better understood and priced. So to end on a more constructive note, it doesn't mean that there's not opportunities, but the selection of the areas to invest, the asset classes and the regions will be far more important in that scenario. Policies might well fall into place and provide a supportive backdrop, but we simply don't know. And this is why you haven't heard from anyone today a 12 to 18 month view, because it is simply too risky to come out with calls like this with binary risk around policies that simply we don't know so far.
Thank you, Sonja. Really interesting. And of course, we will all be back over the coming months to share our perspectives with clients as those various risks and opportunities unfold next year. Well, as we always do, I'm finally going to ask all of our speakers about what you're planning to watch, read, or listen to, or just consume over the festive period. I'll get the ball rolling and say I'll be finishing the BBC series of Wolf Hall, which is wonderful. Love the Hilary Mantel novels, and the TV show. It really, reminds me of lots of things that happen in the political world that Sonja you just mentioned. Rob, over to you.
It's not very festive, but I do like dystopian sci-fi. So I'm just starting season 2 of Silo on Apple TV, which I like a lot.
Great, thank you, Chris.
Embarrassingly, I'm a very similar age to Macaulay Culkin. So I will be watching Home Alone and not Home Alone 2, which is not a comment on Donald Trump's cameo appearance in the sequel.
Good to know. Great film. Sonja.
That's difficult to top, and I haven't checked whether I'm the same age or at least close. But so in the festive spirit, all-time favorite, and I think I actually said it last year, has to be The Grinch with Benedict Cumberbatch as the voice of the Grinch. It's just the most amazing Christmas movie, I find. But at the same time, I'm looking how I can watch the the documentary around Alfred Herrhausen, one of the great German bankers who was assassinated back in the day. And they have now finally produced a documentary on his life. Unfortunately, only available in Germany so far, but I'm trying to get my hands on it. I hear the reviews are absolutely amazing.
Great, thank you. Howie?
Sounds like Chris and I, same household, Home Alone as well. So unfortunately, we've already started. Watched Home Alone 1 on the 30th of November with my son, who's obsessed with it. And so I suspect that'll be 2, 3. Is there 4 and 5 now as well?
They keep going.
They do keep going. So yeah, that's going to definitely keep us going. But at the same time, my wife and daughter are prolific users of Duolingo. So I think I need to join that and start learning some Italian and French so that next year I can probably watch the Home Alone series in those languages.
Okay, well, come back and tell us about it next year. Colin, finally.
Yeah, and I'll round it off at the less sophisticated end. We always watch the film Elf with Will Ferrell, and for the very few that haven't seen it, it's about a 6'3" grown man in yellow tights and an elf costume. What's not to love about that?
Thanks, Colin. We've got a great and eclectic set of recommendations for our listeners for the holidays. And it's a great point on which to end today's call. Thank you, Sonja, Howie, Rob, Colin, and Chris, for your time today. Thank you to you, our clients and listeners, for joining us. You'll be able to find our 2025 Global Outlook on our website from Monday and see other updates on our social media channels, on our blog, and of course here on our podcast. From all of us here at Legal & General, we wish you and your loved ones our warmest season's greetings. May the new year bring you joy, prosperity, and many cherished moments with those you hold dear.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal & General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market, or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal & General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal & General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal & General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.